$120 per ounce. That's where silver closed last Thursday before shedding nearly 14% in 72 hours. Gold dropped hard too, pulling back from record highs in what felt to many like a sudden reversal. But here's what most people missed. This wasn't sudden at all. It was systematic, orchestrated by forces that have nothing to do with the value of the metals themselves and everything to do with how modern markets actually work. If you've been watching your grocery bills climb, your energy costs rise, or your savings lose ground to inflation, this crash matters more than you think. Because what just happened to gold and silver is a signal about liquidity, about positioning, and about the invisible machinery that moves money in ways most people never see. Start with the simplest explanation, the one that gets buried beneath all the noise. Gold and silver had an extraordinary run. From late 2023 into early 2025, both metals climbed relentlessly as investors piled in, betting on persistent inflation, geopolitical tension, and central bank buying. That trade got crowded. When a trade gets crowded, it becomes fragile. Everyone's holding the same position, everyone's watching the same charts, and everyone's thinking about the same exit. The moment sentiment shifts, even slightly, the rush for the door begins. This is profit-taking at scale, magnified by leverage, and it doesn't need a crisis to trigger it. It just needs a catalyst. That catalyst arrived quietly through the US dollar. Over the past month, the dollar index strengthened against most major currencies, driven by better-than-expected economic data and shifting expectations around Federal Reserve policy. When the dollar rises, commodities priced in dollars become more expensive for foreign buyers. Demand softens. At the same time, real yields, the return on government bonds after accounting for inflation, started climbing. Real yields are gold's natural competitor. Gold pays no interest, offers no dividend. When you can park money in a treasury bond and earn a positive real return with zero risk, the opportunity cost of holding gold increases. Capital rotates. The metal loses its appeal not because it's less valuable, but because the alternatives improve. Then came the margin calls. This is where the story gets mechanical, almost algorithmic. Many traders don't buy gold and silver outright. They use leverage, borrowing against their positions to amplify returns. When prices start falling, brokers demand more collateral. If you can't meet that demand, your position gets liquidated automatically. Forced selling. This creates a feedback loop. Selling pushes prices lower, which triggers more margin calls, which forces more selling. It's not panic, it's programming. The system is designed this way, and once the cascade begins, it doesn't matter what fundamentals look like. The machinery takes over. Silver amplified everything. It always does. Silver is smaller, thinner, more volatile than gold. Its market cap is a fraction of gold's, which means the same dollar flow has an outsized impact. But silver also carries industrial demand. It's used in solar panels, electronics, batteries. When economic data suggests slowing growth or when manufacturing indicators soften, that industrial component gets repriced immediately. Gold is a monetary metal. Silver is half monetary, half industrial. That dual identity makes it whipsaw harder in both directions. When gold drops 3%, silver drops 6%. When liquidity tightens, silver feels it first and worst. None of this is new. The pattern repeats because the mechanics don't change. Go back to 2008. Gold fell sharply in the months following Lehman's collapse, even as the financial system unraveled. People expected gold to surge, but instead it sold off. Why? Because institutions needed cash. They liquidated whatever they could, including safe havens, to meet redemptions and cover losses. The same thing happened in March 2020 when COVID hit. Gold dropped over 10% in 2 weeks. Not because investors lost faith in it, but because liquidity dried up and forced sellers had no choice. These aren't anomalies. They're features of how markets behave under stress. Gold and silver are liquid assets, which means they're the first things people sell when they need to raise cash fast. The crash we just saw doesn't require a financial crisis. It just requires the same underlying pressures: positioning, leverage, and a shift in the landscape that makes holding these metals less attractive in the short term. So what does this mean for you, someone who doesn't trade commodities, doesn't watch futures markets, doesn't have a brokerage account? It means something about the system's confidence in inflation and growth. When gold and silver crash together, it often signals that markets are repricing inflation expectations downward or that confidence in economic stability is returning. That might sound like good news, but it's more complicated. If inflation expectations are falling, it's often because growth is slowing. If growth is slowing, job security weakens, wage growth stalls, and the cost of living doesn't necessarily drop at the same pace. You're left in a zone where prices stay elevated, but the economy cools. That's not an easy environment for most households. There's also the purchasing power question. Gold and silver are stores of value, but they're volatile. This crash reminds us that even traditional hedges can lose ground quickly. If you're holding savings in cash and inflation remains stubborn, you're losing purchasing power. If you're holding metals, you just watched value evaporate in days. The takeaway isn't to abandon either strategy. It's to understand that timing, positioning, and market structure matter as much as fundamentals. This is not financial advice, just educational analysis. But the lesson here is that nothing moves in isolation. Gold doesn't crash because gold is worthless. It crashes because the system around it shifts. What you should watch now is simple: track the dollar. If it continues strengthening, pressure on commodities persists. Watch real yields. If they keep climbing, the competition for capital intensifies. Listen to central bank communication, especially from the Federal Reserve. Any hint that rates will stay higher for longer or that quantitative tightening continues will keep a lid on speculative assets. And pay attention to liquidity conditions. If credit markets tighten, if corporate borrowing costs rise, if margin debt starts unwinding, you'll see more forced selling across asset classes, not just metals. This crash wasn't random. It was the result of overlapping forces that converged at the same moment, all of them predictable if you know where to look. Markets have memory. The patterns don't repeat exactly, but they rhyme. If you found this breakdown valuable, subscribe so you don't miss the next one. And drop a comment. Do you think this sell-off is temporary, or is this the beginning of a longer unwind?